The fluorescent lights of the Federal Reserve building in Washington cast long shadows across the conference room, where 12 of America's most powerful banking executives had gathered on a cold February morning in 2025. What transpired behind those closed doors would mark the beginning of an unprecedented shift in American financial history, one that would see the nation's largest banks embark on a gold buying spree that defied conventional wisdom and sent shockwaves through global markets. The story begins not in Washington, but in the trading floors of JPMorgan Chase, where veteran commodities traders had been watching something unusual unfold since the early days of the Trump administration's second term. Gold, that ancient store of value that modern finance had largely relegated to the sidelines, was experiencing something extraordinary. The metal had crossed the psychological barrier of $4,000 per ounce in October. But this was more than just another milestone. It was a signal of fundamental changes in the global financial architecture. Gregory Shearer, the head of precious metals strategy at JPMorgan, had been one of the first to recognize the pattern. For months, he had observed central banks around the world accumulating gold at rates not seen since the 1960s. China, Russia, Turkey, Poland, they were all buying, and they weren't particularly concerned about price. This wasn't the cautious, opportunistic purchasing of previous decades. This was systematic, deliberate, and most importantly, it was accelerating. The American banking establishment had initially watched from the sidelines, confident in the supremacy of the dollar and the depth of US Treasury markets. But as winter settled over New York in early 2025, that confidence began to crack. The trigger wasn't a single event, but rather a cascade of realizations that swept through corner offices from Manhattan to Charlotte. The US federal debt had quietly crossed $29 trillion, a number so vast that even seasoned financiers struggled to comprehend its implications. More troubling still was the trajectory there seemed to be no political will to reverse course, and the new administration's policies promised only to accelerate the spending. At Bank of America's headquarters in Charlotte, senior executives convened emergency meetings to discuss what their research teams were calling a monetary regime shift. The bank's analysts had discovered something remarkable. For the first time since 1996, central banks globally held more gold than US Treasuries in their reserves. This wasn't just a statistical curiosity, it represented a fundamental vote of no confidence in the paper, promises that had underpinned the global financial system for decades. The situation was particularly acute for American banks because of their unique position in the global financial ecosystem. Unlike their European or Asian counterparts, US banks had deep structural exposure to the dollar system. They held vast quantities of treasuries, facilitated dollar-denominated trade, and served as the plumbing through which global capital flows moved. If the world was truly beginning to move away from the dollar, a process some were calling de-dollarization, American banks would need to adapt or risk being left behind. Wells Fargo was among the first to act. In a move that surprised even industry insiders, the bank began quietly accumulating physical gold in early 2025, not just as a trading position, but as a strategic reserve. The bank's risk management team had run countless scenarios, and in almost every one where fiscal uncertainty persisted and geopolitical tensions remained elevated, gold outperformed traditional safe havens. What made their decision particularly notable was the price they were willing to pay, well above spot market rates in many cases, suggesting an urgency that transcended normal profit considerations. The mechanics of these purchases revealed the sophistication of the operation. Banks weren't simply calling up gold dealers and placing orders. Instead, they were engaging in complex transactions involving futures, contracts, physical delivery arrangements, and international logistics. JPMorgan alone issued delivery notices for nearly 1.5 million ounces of gold against futures contracts in New York, a transaction valued at over $4 billion. This wasn't paper trading, this was real metal moving into vaults beneath Manhattan. The timing of these purchases coincided with another development that had Wall Street on edge: the Trump administration's aggressive trade policies, particularly the threat of sweeping tariffs. The president had implemented what he called reciprocal tariffs in April 2025, a move that sent shockwaves through currency markets and accelerated the dollar's decline. For banks, this created both a crisis and an opportunity. The crisis was clear: a weakening dollar threatened the value of their treasury holdings and complicated international transactions. The opportunity lay in gold's inverse relationship with the dollar. As the greenback weakened, gold priced in dollars naturally appreciated. Morgan Stanley's precious metals desk became a hive of activity as traders worked around the clock to secure gold supplies. The bank was particularly focused on what traders called the arbitrage play, exploiting price differentials between London spot prices and New York futures prices. With tariff fears driving COMEX futures to significant premiums over London spot, banks with the infrastructure to quickly move physical metal between markets could profit handsomely. Planes loaded with gold bars became regular fixtures at Kennedy and Newark airports, modern-day treasure ships carrying billions in bullion. But profit wasn't the only motivation. Behind the trading desks and arbitrage strategies lay a deeper concern that kept chief risk officers awake at night. The sanctions imposed on Russia following its 2022 invasion of Ukraine had demonstrated something that many had long suspected but few had fully appreciated. Dollar assets could be weaponized. When the United States froze Russian central bank reserves and cut Russian banks off from SWIFT, it sent a clear message to every financial institution in the world. Your dollars are only as safe as your relationship with Washington. American banks, despite being ostensibly on the right side of these sanctions, understood the implications. If geopolitical tensions continued to escalate, if the world continued to fracture into competing blocs, then even American institutions might find themselves needing assets that couldn't be frozen with a keystroke. Gold, sitting in vaults under their direct control, offered that security. It was insurance against a world where financial weapons had become as important as military ones. The Federal Reserve, for its part, found itself in an impossible position. Jerome Powell and his colleagues were acutely aware of what the banks were doing. The data was impossible to hide. But any public acknowledgement risked accelerating the very trends they hoped to prevent. Behind closed doors, Fed officials engaged in intense debates about whether to intervene, but ultimately concluded that any action might do more harm than good. The market had made its decision, and fighting it would only underscore the central bank's weakness. As spring arrived in 2025, the pace of bank gold purchases only accelerated. Goldman Sachs joined the fray with massive delivery notices, while regional banks, not wanting to be left behind, began their own accumulation programs. The price of gold continued to climb, crossing $4,300 per ounce by May, but the banks kept buying. Their research departments produced report after report justifying the strategy, citing everything from technical analysis to thousand-year historical precedents. What made this phenomenon particularly remarkable was the contradiction it represented. Banks are inherently creatures of the fiat money system. They create money through lending, profit from interest rate differentials, and depend on central bank liquidity. Gold, by contrast, represents the antithesis of this system. It cannot be created at will, pays no interest, and exists independent of any central authority. For banks to embrace gold so enthusiastically suggested a profound loss of faith in the very system that had enriched them. The international response to American banks' gold purchases varied widely. European banks, already more comfortable with gold given their longer historical experience with currency crises, saw it as a sensible precaution. Asian institutions, particularly those in China and India where gold has deep cultural significance, viewed it as long overdue, but it was the response from emerging markets that proved most interesting. Countries that had long chafed under dollar dominance saw American banks' gold purchases as vindication of their own policies. Inside the banks, the gold purchases created unexpected cultural changes. Trading floors that had once obsessed over basis points and yield curves now tracked mining production and vault capacity. Young analysts who had joined banks to work on exotic derivatives found themselves studying geological surveys and transportation logistics. The physical nature of gold, its weight, its storage requirements, its security needs introduced a tangible element to institutions that had increasingly existed in the abstract world of electronic transfers and digital ledgers. The storage question became particularly acute as purchases mounted. Bank vaults that had been largely ceremonial for decades were refurbished and expanded. JPMorgan's famous vault under Chase Manhattan Plaza, which could hold over 500,000 gold bars, went from tourist curiosity to strategic asset. Banks invested millions in security upgrades, including biometric scanners, armed guards, and sophisticated tracking systems. The contrast with Treasury holdings, which existed merely as entries in Federal Reserve computers, couldn't have been starker. By summer 2025, the pattern was unmistakable. American banks were systematically converting a portion of their reserves from dollars and treasuries into gold. The numbers were staggering. Collective purchases exceeded 300 tons, worth over $40 billion at prevailing prices. This might seem small relative to total bank assets measured in trillions, but the symbolic importance far exceeded the monetary value. These institutions, pillars of the American financial establishment, were hedging against the very system they helped operate. The implications rippled through markets in unexpected ways. Treasury yields, which might have been expected to spike as banks reduced holdings, remained relatively stable. Foreign central banks were selling even faster, and the Federal Reserve was forced to step in as buyer of last resort. The dollar's decline accelerated, creating a feedback loop that made gold even more attractive. Stock markets grew increasingly volatile as investors struggled to interpret whether bank gold purchases were prudent risk management or a sign of impending crisis. Corporate clients began asking uncomfortable questions. If banks were buying gold as insurance, should corporations do the same? Some CFOs, particularly at multinational companies with exposure to emerging markets, began establishing their own gold positions. Others went further, requesting that banks offer gold-denominated accounts and lending facilities. A parallel financial system, one based on gold rather than dollars, began to emerge in embryonic form. The academic community watched with a mixture of fascination and horror. Economics professors who had spent careers teaching about the superiority of fiat money over the gold standard found their assumptions challenged. Some argued that bank gold purchases were a temporary aberration driven by unusual circumstances. Others suggested it marked the beginning of a new monetary era, one where gold would coexist with fiat currencies in a hybrid system that combined elements of both. Central banks in other countries accelerated their own purchases in response to American banks' actions. If JPMorgan and Bank of America were loading up on gold, the reasoning went, they must know something. The People's Bank of China, which had already been accumulating gold for years, doubled down on its program. Smaller central banks, from Singapore to Poland, expanded their purchases. The World Gold Council reported that central bank demand in 2025 would exceed 1,300 tons, shattering all previous records. The human dimension of this story played out in countless individual dramas. Traders who correctly positioned themselves ahead of the gold surge became legends, their profits measured in hundreds of millions. Others, who had bet against gold based on traditional models, saw their careers destroyed. Risk managers who had advocated for gold purchases were vindicated and promoted. Those who had resisted found themselves marginalized. The culture of Wall Street, always quick to embrace success, pivoted toward gold with characteristic enthusiasm. As autumn 2025 arrived, bringing with it the first anniversary of gold's breakthrough above $4,000, American banks found themselves in an unusual position. They had successfully acquired substantial gold holdings, providing insurance against various tail risks. But in doing so, they had also contributed to the very phenomenon they sought to protect against the declining credibility of the dollar-based financial system. It was a paradox with no easy resolution. The bank's public communications carefully avoided discussing their gold strategies in detail. Earnings calls featured vague references to alternative reserve assets and portfolio diversification. CEOs, when pressed by analysts, spoke in carefully crafted generalities about preparing for various scenarios and maintaining flexibility in uncertain times. But everyone knew what was happening. The banks were voting with their feet, or rather, with their vaults, and the vote was for gold. Looking back, historians would likely mark 2025 as a turning point, the year when American financial institutions acknowledged what many others had already concluded. The post-World War II monetary order was ending. The Bretton Woods system had died in 1971 when Nixon closed the gold window, but its successor, a pure dollar standard, had endured for over 50 years. Now, that too was giving way to something new, something that hadn't yet fully formed, but would likely involve multiple reserve, currencies, digital assets, and, yes, gold. The psychological impact of banks' gold purchases extended far beyond financial markets. Regular Americans, seeing their banks accumulate gold, began questioning their own financial strategies. Gold dealers reported record sales to retail investors. Coins and small bars disappeared from inventory as quickly as they could be minted. Even those who had never thought about gold found themselves wondering if they should own some, just in case. The government's response was notably muted. While some congressmen called for hearings and investigations, the administration seemed resigned to the trend. The Treasury Secretary, in carefully worded statements, acknowledged that banks had the right to manage their reserves as they saw fit. Behind the scenes, however, intense discussions took place about potential policy responses, including the possibility of new regulations or even restrictions on gold ownership ideas that were quickly dismissed as likely to cause more harm than good. International diplomatic channels buzzed with discussions about what American banks' gold purchases meant for the global order. Some saw it as America retreating from its role as guardian of the international monetary system. Others interpreted it as a strategic repositioning ahead of a new phase of great power competition. The Chinese in particular viewed it as confirmation that their long-term strategy of accumulating gold and promoting alternative payment systems was correct. As 2025 drew to a close, the gold price approached $5,000 per ounce, a level that would have seemed absurd just years earlier. American banks, sitting on massive paper profits from their gold holdings, faced new dilemmas. Should they take profits? Continue accumulating? The answer, for most, was to hold and selectively add to positions. The factors that had driven them to gold: fiscal concerns, geopolitical tensions, monetary uncertainty showed no signs of abating. The story of why American banks suddenly began buying gold at inflated prices in 2025 is ultimately a story about trust, or rather, the loss of it. Trust in governments to manage finances responsibly, trust in central banks to preserve currency value, trust in the international system to remain stable and open. When that trust eroded, even institutions at the heart of the system felt compelled to seek alternatives. Gold, with its long history as a store of value independent of government promises, emerged as the obvious choice. This transformation didn't happen overnight. It was the culmination of trends that had been building for years: rising debt levels, increasing weaponization of finance, growing multipolarity in global politics, and persistent inflation concerns. The banks, with their armies of analysts and risk managers, simply recognized these trends before they became obvious to everyone else. Their gold purchases in 2025 weren't really about gold at all. They were about positioning for a fundamentally different financial future. As one senior banker, speaking anonymously, put it during those frantic months of accumulation, "We're not buying gold because we want to, we're buying it because we have to. The world is changing, and we need to change with it." The price today, whether it's $4,000 or $5,000 an ounce, won't matter if we're right about where things are heading. And if we're wrong, well, then we own a lot of very expensive insurance. Given what we're seeing, that's a trade we're willing to make. The reverberations of 2025's Great Bank Gold Rush would be felt for years to come, reshaping not just portfolios but fundamental assumptions about money, value, and trust in the modern economy. The age of unquestioned dollar supremacy was ending, and American banks, those great institutions that had prospered so mightily under the old system, were among the first to acknowledge this new reality. Their golden hedge against an uncertain future would prove to be either prescient preparation or expensive paranoia. Only time would tell which interpretation history would favour.